Dividend yields are rising, the market is declining. This is creating buying opportunities, especially for dividend investors. There's one problem with this, at least for my portfolio. You see, there is a portfolio performance measurement used to measure the dividend yield versus the yield on cost of a portfolio. Now, the dividend yield of a portfolio is simply taking your stocks and showing what the dividend yields of those stocks are at current market values. So if you were to buy your stocks today, what would the yields be? It's a simple equation, and it is the annual dividend divided by the market price, which gives you your dividend yield. So if Microsoft pays out annually a dividend of $3 per share and the current market value is $321.80 per share, then you take that $3 divided by that $321.80 and you get a 0.93% dividend yield. Now, yield on cost is different and a very important tool to incorporate into your portfolio. This is simply taking the cost you purchased your share at, or the average cost if you own multiple shares, and applying the current annualized dividend payout of that company. This is determining the actual dividend yield you are currently getting on your shares you own for a specific company, factoring in the cost you paid. Instead of before, where we were looking for the yield of the companies you own if you were buying at today's market prices. So it's a good way to see if your yield on cost is doing better than the yields at today's current market prices. So for a yield on cost example, let's say you bought one share of Microsoft 1 year ago for $200 and the current annualized dividend payout is $3 per share. So your yield on cost would be 1.5%. Now, remember, if you were to buy today at that $321.80 per share price, your yield would have been the 0.93%. But because you bought a year ago at a much lower valuation of $200 per share, your yield instead is 1.5%. Big difference. This is what you want, for your yield on cost to be higher than your dividend yield measured at current market valuations. This is the power of buying quality companies that increase their dividends annually and that their stock price appreciates every year due to excellent performance and growth of the company, etc. If your yield on cost is lower than your dividend yield at current market prices, then that means that the share price has declined below your purchase price of that stock. For example, if you buy Microsoft at $200 per share with a $2.75 annual dividend, that gives you a dividend yield of 1.375%. If the share price drops from $200 down to $150 per share and Microsoft is still paying that $2.75 annual yield, that means someone can buy in lower today than you did and get a higher yield of 1.83% versus your 1.375%. This could signal a bad investment. So you're talking bad financials, litigation, declining business model, something that is causing the share price to tank. Or it could be hard economic times, such as a recession, so it does not always signal a bad investment, as it could be a market-wide effect. So my dilemma is, well, let's just take a look at my portfolio performance. For a long time, my yield on cost was higher than the dividend yield at market value, but it has now inverted and I basically could have just bought at current market valuations and have received a better yield than when I originally bought my shares. So you'll see my yield on cost is lower at the 3.1% versus the dividend yield at current market valuations at the 3.27%. Now, is it due to bad investments or economic factors? Well, it's a mixture of both, but luckily more so economic factors. So I do hold what I consider 3 bad investments: AT&T, Warner Bros. Discovery, and 3M. These 3 companies have been in decline for some time, and it's mainly due to bad business practices, weakening fundamentals, poor financials, etc. These are investments I want to eventually sell out of. Now, if I had to rank these from best to worst, I would say AT&T is the best out of the 3. It provides a necessary service and acts like a utility. Management is focusing on reducing their high debt levels, though not at the rate they promised, but they are doing so nonetheless. So I see AT&T as one that has improving fundamentals and is a more solid company than the other 2, and hopefully I can sell at a profit someday. In second place is Warner Bros. Discovery with its streaming service, Max. I admit Netflix is the superior streaming company, but I feel Max is the next best one. One can argue Disney Plus is the second, but to me Disney just cannot pump out the content fast enough, and it is viewed as more of a kid's streaming service, so I see more limitations than Max. I pay for Max and think they have amazing content, and is one that should be able to retain and grow its subscriber base and become profitable someday, just not at the pace and levels as Netflix. So I'm hopeful I can sell in the green someday with this one. In last place is 3M. This is a company that is always dealing with expensive litigation, has weaker recurring revenue compared to the other two, financially is not impressive, and unfortunately, I think I will have to sell at a loss. 3M has potential to turn things around. It is a large company with many widely used products, but it is one that just cannot get it together. So not the worst investment out there, but definitely nowhere near the best. So these three companies, besides Warner Bros. Discovery because they do not pay a dividend, have contributed in a negative way towards my yield on cost being lower than the dividend yield at market value. All my other companies I consider of high quality, and any in the red are mainly due to economic factors, so high stubborn inflation, the high interest rates, a slowing economy, etc. These are factors us investors cannot control, and the sector being hit the hardest by these negative economic factors is the real estate sector. As you can clearly see, Vici is down over 6% and realty income is down over 13%. But I have zero worries about these companies surviving a recession or hard economic times. They have proven they can do so time and time again. Sure, if I had a crystal ball and knew they would be at these levels, I would have waited to buy, but obviously that darn crystal ball that works has not been invented yet. Instead, as investors, the one thing we can control is finding quality companies, and when the rare opportunity arises where we get to average down due to high fear levels from investors that are a sector-wide fear instead of a specific company fear, meaning there's nothing fundamentally declining with these companies, we should be buying. And the best way to do that is to dollar cost average to capture the full dip, as you cannot predict the future. Realty income and Vici are still collecting 99 to 100% of rents. AFFO is increasing. They are acquiring more properties. They do triple net leases. They have rents that are covered by a CPI protected agreement, meaning rents will rise annually based on inflation, etc. I mean, I could go on and on. In fact, I just went over my bullish case on realty income. If you're interested in my video that I released a few weeks ago, just go through my channel and you'll find it. So what I am saying is that the fear causing these companies to sell off dramatically does not match up to the companies themselves, as they are still growing and performing quite well. So keep your fear if you want to, but I will ignore that fear and go off of facts and my research and take this rare opportunity to average down. Not just in these, but in any opportunity I see here in my portfolio. I am okay dealing with the fact that my yield on cost is lower than the yield of the current market values. For one thing, I have only been investing for 3 to 4 years, so I cannot expect my cost to be much lower than the market price versus someone that has been investing for 20 years and is at a lot less risk of any quality investments going below prices that were 10, 15, 20 years ago versus a 3 to 4 year time period. Second, I am in quality companies and am seeing a rare opportunity I know I will be happy I took advantage of later when these stocks race back up past my purchase prices, and you know what that will do. It'll create a higher yield on cost eventually that is more solid than before. So take the opportunity, ignore the fear, focus on fundamentals and quality of your companies. Be sure to take the time to calculate your yield on cost versus the dividend yield at current market values. It gives you more insight on your investments and where potential deals are hiding. Before I sign off, be sure to look at the 3 membership tiers I created, each with unique perks. It's another way to support this channel and someone who is dedicated towards helping all of us grow and become wealthy over time. A lot of work goes into these videos, and I would appreciate your consideration. The link is in the description for more details. There's also a thanks button you can utilize if you'd like at the top, or right below the video, shall I say. So thank you for tuning in. Have a great day, and see you soon on Mark Arnold's Finance.